Welcome to the Power and Market Report. I'm Albert Liu. It's another day of volatility for investors as hope for a government stimulus package pushes the Dow Jones Industrial Average back above the 20,000 point mark. But how long will it last? Joining me now is the editor of Grant's Interest Rate Observer and the author of several books, including The Forgotten Depression, 1921, The Crash That Cured Itself. Jim Grant, welcome to the Power and Market Report. It's a pleasure to have you on. And I promised you just now that I will not require you to answer that question, but I'm sure we'll have plenty of things to talk about. How are you?
I'm fine. Thank you, Albert.
Something tells me that the story of 2021 is going to be a little bit different than that of 1921. So where shall we begin?
How about 2020?
Okay. What are your thoughts on what's going on, say, the past week or so?
Well, it is a light show. I guess the big question is whether Mr. Market has ceded operating control of finance to Uncle Sam in the shape of these quite gob-stopping interventions. And on the face of things, it looks as if that were possible. Only September before the pandemic, the Fed intervened in response to a kind of anomalous, unscripted spike in the so-called repo rate. That's the rate at which you can borrow against the apparently spotless collateral of the United States Treasury. But on that particular day, was it September 7th? Maybe I forgot the date. But in early September, that rate spiked above 9, back close to 10. And that was a cue for what would then seem a rather sizable succession of Fed interventions to tamp down that rate and to facilitate the continued funding of our outsized then boom time Treasury deficits. So what has happened in the past 2 weeks has been probably, I guess the most outsized and stunning succession of interventions in the history of modern central banking. It's not unprecedented that central banks do unconventional, even radical things in the face of extreme turbulence. In 1825 in England, there was a very, very severe depression and financial panic. And the Bank of England did all manner of unconventional things to actually lend against physical merchandise, which was an extreme step. I'm sure mortified the more orthodox among the directors of the Bank of England. But in 6 hearings in 1832, I guess, one of the directors of the Bank of England was asked about this. And, how does he explain what had happened? This guy was named Jeremiah Harman, long-serving director. And he said that we lent it, quote, we lent it by every possible means and in modes that we never had adopted before. That seeing the dreadful state in which the public were, we rendered every assistance in our power. And he added that upon some occasions we were not over nice. I love that, over nice. So one could invoke that historical precedent as kind of a calming fact in the service of damping one's anxieties about the apparent federal takeover of price discovery. One could, I just have, I guess, to a degree, but I myself am not mollified. I think that what has leapt out of Pandora's box of intervention will not be so easily returned there.
Jim, how different is that the Bank of England's approach to lending against physical goods to what apparently the Fed is going to do with a mainstream lending program or the relaunched term asset-backed loan facility, where they're going to try to get money and credit into the hands of merchants. Isn't that essentially the same thing? Maybe with some.
Well, no, it's not the
fancy...
same thing. But it's never, of course, one cycle to the next, one episode of financial improvisation to the next. It's never exactly the same thing. And I don't mean to be pedantic. You didn't mean it was exactly the same thing. Certainly, the spirit of innovation is comparable. One cycle, 200 years compared to the next. 200 years ago compared to this one. Another point of comparison is the Bank of England then was, in part, a commercial bank. It was doing its own commercial discounting of trade bills and the like. It was lending and taking deposits. So the Fed, with these interventions, has become, or is becoming, a kind of commercial bank, right? It's undertaking direct credit infusion into the economy rather through intermediaries. It is also acting with unimagined hundreds of billions of dollars to buy more or less everything that's not nailed down, from commercial mortgage-backed securities to residential mortgage-backed securities to commercial paper, backstopping commercial paper, money market funds, of course, treasury securities themselves, ETFs, housing, investment-grade bonds, it takes a while to get used to it all, but it is a fact. And in my country, America, I think you are calling from Canada, right? Aren't you, Albert? Isn't that country?
I'm calling from California.
Oh, California. I said, it's a different country too, in so many ways. But Bernie Sanders is evidently no longer even a remote possibility for the Democratic nomination of the presidency, but his ideas seem to be winning the day, certainly his ideas in finance. And among those ideas, of course, was so-called modern monetary theory, which is that body of thought which holds that the government will do no lasting harm if it monetizes deficits directly, if the central bank prints lots of money, as long as those obligations are not owed except internally, and if there is no inflation at the checkout counter. That's the basic bare bones proposition of modern monetary theory, which Bernie Sanders endorses and would implement. But what are we doing if not that? We were doing that really, in effect, before the administration's program was to borrow and spend without let and hindrance, with no thought at all to orthodoxy and conventional Republican fiscal practice and mores. The other term for modern monetary theory is functional finance. If it works, that's great. No remote consequences of these improvised actions. So that program was in progress in fact, if not in name. And with the Fed's actions this week, my goodness, it almost seems as if it were here. I'll use another press release called Modern Monetary Theory.
Right.
And I know, I'm fully aware that the provocation is that of seemingly an act of God, or at least a viral mutation or something. So we ought not to begrudge the Fed its humane impulses. But how do you not mobilize every single possible tool in your kit or bomb in your arsenal next time there's a downturn in anything? I think this introduces the possibility of everything the gold bugs have been praying for. Are we going to get around to gold, Albert?
That's a little further down. We can talk about it now if you wish.
Well, I can't wait. I can wait.
But one point, though, I wasn't meaning to imply that it was exactly the same thing.
No, of course you weren't.
And I know you weren't suggesting that. But if what is the actual difference in reality, in function, of the central bank directly purchasing something and instead putting it in some kind of special purpose vehicle and buying that instead, or buying asset-backed securities?
I think there's not much difference functionally. I think it's the Fed's conforming to the letter, if not the spirit, of the Federal Reserve Act, and and to the somewhat restrictive legislation that's put in place in the aftermath of the last crisis, the Dodd-Frank Act. But as to outcome, I'm not sure there's much difference.
And
but
what about
the Fed?
What about the practice of buying triple B minus credits that are perhaps soon to become junk, and just buying junk? It looks like maybe we're falling into that trap as well.
Oh, yeah. I mean, this is another nicety. I mean, is the Fed going to blow these things out as soon as it's a downgrade, or is it going to lean on Moody's and S&P not to downgrade the things it has purchased? We are so far down this road already, especially in Europe. I mean, the ECB has been monetizing corporate debt for many a fiscal quarter, and in doing so has utterly corrupted, as far as I'm concerned, the very point of the pricing of credit, the very point of interest rates, which is to allocate capital. These interest rates, both on our side of the Atlantic and theirs, have been suborned into the public service. They've been commandeered. So these prices, which ought to be discovered, I say others, in the marketplace, are instead administered, and they're administered for the very purpose of instituting a desired financial outcome. And this goes back, I guess it goes back a long way, but it goes back from one important observation point. It goes back to 2010, to November 4th, 2010, when Ben Bernanke, PhD, published in the Washington Post an op-ed in which he said he said the following. I happen to have it right here because I'm a prepared kind of guy, but here it is. He's talking about QE, the then novel QE. So, quote, easier financial conditions will promote economic growth. For example, lower mortgage rates will make housing more affordable and allow more homeowners to refinance. Lower corporate bond rates will encourage investment, and higher stock prices will boost consumer wealth and help increase confidence, which can also spur spending, close quote. So that was the great asset lift, right? That was the what they call the portfolio balance channel approach to central banking, in which they would manipulate asset values higher, thereby induce happy outcomes. Well, it turns out that many outcomes were perhaps unintended. One of these outcomes was to impoverish state pension funds, which have discovered what Ben Bernanke, PhD, no doubt knew, at least in the back of his mind, which is that if you beat down interest rates, and if you do that, you require much more capital to generate a given stream of income, right? At 5% per year, $1 million earns you $50,000. But at 1% a year, you need $5 million to generate that same $50 million of interest income. So it's kind of chasing your tail a little bit, right? So you make it on the asset appreciation, but you lose it on the liability side. Balance sheets having both liabilities and assets. So one of the other unintended consequences of this 10 years of suppressed interest rates and predictable financial interventions by the Fed, well, they've given us near record high equity valuations that they did about 15 minutes ago, till it all ended, or at least paused. We don't know. They gave us perhaps more corporate debt per unit of corporate earning power than ever before, and much of this debt of a very low quality. They've given us unicorns. They have given us zombies. They have given us all manner of things, some pleasant to be sure, but many corrosive. And what they have not given us is any economy-wide or political community-wide new revelation into the dangers of the manipulation of the most sensitive prices in capital, namely interest rates. That's my hobby horse. But I think it's a very, very dangerous road. We haven't even talked about inflation. Nobody talks about inflation, right? Imagine had this conversation like 35 or 40 years ago when inflation was still a thing, and I said, Albert, what do you suppose the consequences might be of an immense infusion of new bank credit and to the fiscal program that is likely to reach 10% of GDP? How would you guess that would affect the price level? And you would think to yourself, that idiot is asking, and you would say, because you're very polite, you say, well, Jim, I suspect that might lead to a bump higher in inflation. But today, no one thinks that. You can look at the futures curve and various interest rate derivatives that at least reflect current thinking on the likely course of rates and inflation, and nobody really, they're flat. Nobody is anticipating any adverse inflationary outcome from this, which I find is a remarkable commentary on the complacent. We're not thinking most days with VIX readings at 75 and 80 of complacency, but with respect to inflation and its prospects, there is certainly complacency rampant. So.
Yeah, my suspicion, Jim, is that people who manage money have more urgent matters that they're dealing with right now. And one of them is a topic that I wanted to discuss with you. You asked about what is to be done in the face of extremely low interest rates. I think leverage is another thing that people have discovered that is helpful in bringing yields up. And if you look at the commercial mortgage market right now, it's melting down. The Fed pledged to begin purchasing agency MBS, but that hasn't been enough. So what are your thoughts on that market? What's happening there? And what's going to happen if people stop paying their rents?
Yes. Exactly what we think is going to happen. And that something is more. Once you have said, without let or hindrance, once you've said we'll do all we have to do, there is no check, is there? I mean, Chairman Powell cannot now say, God, a $5 trillion balance sheet is kind of a little bit queasy. I think we're going to just lay back on the oars here for a few weeks and see what. No, that's not going to do it. So if the announced scale of operations to tamp down, and so besides that, it's residential mortgage backed securities that are also in trouble. These mortgage real estate investment trusts, at least one or two of them had forcibly had to deleverage and sell assets. So if what they have done and announced is not enough, there'll be more. And again, precedents are being set.
Yeah.
Can't say it's dull. Can't say it's dull.
The white paper from the chairman of Colony Capital is suggesting familiar things, actually. When you hear things like systemic failure colliding with mark-to-market and margin calls, the solutions are often similar, which is suspend mark-to-market, freeze assets in their place, extend liquidity. I'm just wondering, if we do it again, where is this all going to end?
Well, that is a great question. Where does it end? And unfortunately, it's a great rhetorical question because we don't know. We have our conjectures, we gold bugs. I used to count myself as a gold bull because I thought gold bug was just a little bit undignified for such a dignified fellow as myself. But I've just come to just throw my lot in with all the other guys. All right, fine, gold bug. But where were we? Bemoaning what? Leverage, yes. Well, the invitation to borrow and lend at interest rates pitched below the rate of inflation, and with the assurance that those rates would not be meaningfully adjusted higher, that state of affairs has called forth all sorts of networks of leverage, the existence of which we are discovering day by day, to the company with the sound of popping rivets in our finances. And you can hear those rivets pop in the residential mortgage-backed securities market. You hear it pop in CMBS. We can hear it, and of course in corporate bonds. and it is most disquieting. And also, it is most out of the intellectual tradition of sound finance, which word sound finance, of course, the modernists disparage. Albert, I'm going to read you something from Graham and Dodd that speaks to the very nature of an investment-grade corporate bond. When
James,
you hear this, I think...
Yeah.
Yep.
Before you do that, can I just pause for a sponsor message?
Oh, yeah.
This would be the time to do it.
Commerce.
However, I don't have sponsors. So what I was hoping is that we could talk a little bit about, your podcast, Current Yield, and that you would do a live read of a promotion for your fine publication, Grant's Interest Rate Observer. But in doing so, I was hoping you could indulge one of my pleasures, Grant. I am a fan of your podcast, Current Yield. I'm a little surprised a man of your experience and breadth of knowledge didn't go with something like Yield to Maturity, but it's still a good name. One of the things I really enjoy about your podcast, in addition to the topics, the guests, the all of the insights, is the way that your skill in segueing into commercials. No matter how large the bridge is to gap and how short the time is, there's no one better at ramming a square peg in a round hole than you to get to the sponsor message.
Well, others have said that with respect in other contexts as well. I've taken it always as a compliment.
It's an unusual skill. So
well,
what I'm going to do...
Sorry. Okay.
I'm going to simulate a podcast discussion, and then I'm going to cue you to segue into a commercial for Grant's Interest Rate Observer, and I'm going to set the gap as wide as possible just to showcase your skills in doing this. So here we go.
Bring it on.
Jim, I was at Costco the other day, and I just can't believe they're still out of toilet paper. It's just incredible.
Well, Albert, that reminds me of my life's work, Grant's Interest Rate Observer, because the price that we ask for this invaluable fortnightly journal of everything you need to know about finance is $1,295 a year, which is actually cheaper than a club pack of toilet paper and or Purell. So what do you want in times of financial difficulty? Those consumable objects, or do you want something more or less eternal like our pros? I put it to you.
I also note that the price curve on that is inverted, in that the 2-year price is lower than the 1 year.
Well, per issue, yes, you get a small discount for doing 2 years. Yeah, and they slow. Yeah, right. All right. Yeah.
Wonderful. Thank you very much. Okay, so back to the show. You were going to read me something from Graham Dodd.
This Graham and Dodd. This speaks to the shock value of the state of the corporate debt markets now, the investment grade market in particular, and the shock value that these securities should be kind of bid wanted, that the discontinuity should be as great as they are, that they should be, the spread should be gapping so much. Okay, so here is Graham and Dodd on the nature of bonds. So, quote, the soundness of straight bond investment can be demonstrated only by its performance under unfavorable business conditions. If the bondholders needed prosperity to keep them whole, they would have been smarter to have bought the company's stock and made the profits that flow from prosperity. Close quote. So it's adversity that tests the merits of a bond, not some debt-fueled, leveraged, enhanced, modern central banking jive boom. And Graham and Dodd published their first edition in 1934, so they were writing it in 1931, 32, and 33, which, by the way, was a great feat of moral courage, because Graham was himself getting blown out of the water in his own leveraged partnership during the Depression.
It seems like in this situation, so in the most trying circumstances, we will really not get to see our grade on that test, because we'll never get to that point. The bailout will come first.
I guess, yeah. I mean, it seems, I don't know how there is no bailout, we have demonstrated this week that it is possible. Who knows? Maybe today we're speaking on what a Tuesday. I forget.
Right, Tuesday just after
these
market
days do
close.
run,
Yeah.
These days do run together when you're sitting at home in your khakis. But the market's up 10% or something. So maybe that's the bottom. We can't know. I don't think so, but sure, could be. And if so, if that is the demonstrated efficacious use of massed central bank power without, supposedly, an adverse consequence awaiting us, that I think that solves mankind's age-old dilemma of scarcity. Right? If this is possible, if you can conjure without adverse effects trillions of dollars of new credit, and everything is better because of that, net better. Wow! I suppose we wish that that had been discovered in the Iron Age. We would have been a lot richer by now. But so as you can tell by my sarcastic tone, Albert, I do not believe that's the case. I do not believe that this is consequence-free, or certainly not adverse consequence-free. And I think it's time for people to give some thought to that topic in finance, which is paradoxically given almost no attention. Namely, what's money and who says so? That is the fundamental question of finance. These billionaires who go around talking, who go around begging the Fed to do these things, and there are many of them, including some professed libertarians. We got to fiscal policy. We need to more monetary. Well, what is it? What's their wealth denominated in? Are they not concerned a little bit about the nature of the money that is holding their own life's work? And that's what it amounts to. So,
James,
money amounts to. Yep.
Another question for you, and this one is admittedly more difficult than the commercial segue test, but it's a very important question because we're looking for answers. And I know that you're not in the business of prescribing things, but the suggestion box is wide open. All kinds of people are giving the president advice on what he should be doing or what the Fed should be doing. And like it or not, we are in this situation. So given where we are, what is, in your opinion, the best course of action for the fiscal authority and the monetary authority?
I don't know. I mean, I think the country ought not to be shut down. I think that that life goes on, and that the order to stand still and suspend commerce is probably ill-advised. But that's not the question you posed.
It's an important one too, though. So thank you.
Yeah, I was on CNBC a little while ago, and somebody asked me this, and I said, we could, somebody said there's no trade-off in between health and commerce, and well, of course there is. We suffer collectively 40,000 deaths a year on the highways, and we could reduce that substantially by posting a 20-mile-an-hour speed limit. And we don't do that, not because we're callous, but because we live our lives and we take chances. We get up, when you get up in the morning, you're taking a chance. And I don't know. I speak as few talking heads do speak, with certifiably no epidemiological knowledge at all. I skipped that course entirely. So I don't pretend to speak from anything more than newspaper reading prejudice on this matter, but I think that the go hide in the hole approach is probably not well advised.
What about regarding bailouts?
No, I mean, there's a bankruptcy system, and if the airlines have levered themselves up to the point of vulnerability, they can't survive this, well, they can fire. I don't think they ought to get direct infusions from the state. And the cost of the direct infusions will be the greater socialization of business activity. All these codicils going to be going through with the bailouts. I'm not sure how much of Boeing and stockholders are left over if they take keep the government's money. But let's do something else. Let's talk about something else, because I really have got no advice for the president, and it's the reason I'm not elected to Congress. But what I think the job for an investor is not so much to prescribe an enlightened course of action. We all have our ideas, I guess, even if we don't want to talk about them. But I think the thing to do is to take the measure of the policies in place, take the measure of the precedents that are set, and ask, if you're in the business of speculating in money, to ask, what is going to be the strongest monetary asset in which to house your wealth? That, to me, is the question, not what President Trump ought to do.
Okay, so let's answer that question then.
Gold. Well, go ahead and ask your question.
I was going to say we're back sort of to the beginning of the interview, and my comment was going to be gold has performed well, but it's not acting as if the Fed's balance sheet is headed quickly to 10 or 15 trillion dollars. So is patience in order here for the gold investor?
Yes, patience is absolutely in order, and also gold is. I confess I'm a gold bug, and I blurted out gold before you even asked the question. Yes, but it's not to the end of emulating Scrooge McDuck. That's not the point. The point is to have liquid wealth available when opportunity presents itself. And gold is many things, but it's not regenerative. And there's nothing as an investment like a well-priced, successful, profitable, well-financed business. What you want is gold against for opportunities. You want it opportunistically. You also want it as a not so much as a hedge against monetary disorder, because we have that. You want it as an investment in monetary disorder. That's a second reason. So I guess that's a little bit of Scrooge McDuck reason, but I hold it for those two reasons. And I think that it's going to be helpful for both. I look forward to liquidating some of my gold bullion, as modest as that stack of coins is. I look forward to at some point liquidating that if I have the nerve and the opportunity to accumulate something that is going to be yielding dividends and cash flow. But the other portion I hope will never sell, and that's the bottom dollar, and that is an investment in the evident tendency of monetary affairs. The arc of monetary evolution points to greater and greater interventions, more radical policy, which begets still more radical policy, financial repression, more of that. We've done more QE this week, or will have done more QE this week than they did under the Bernanke Fed. So to me, the arc of this is very clear, and you want gold both for the inevitable spills in the financial and market for financial assets, as well as for the seemingly inevitable destruction of, or certainly impairment of the government's issued money. So those are my reasons.
One last question, Jim. Over the last few weeks, every crisis is a little bit different. I'm wondering, over the last few weeks, has anything surprised you, or has this crisis taught you anything that you didn't know going in?
Oh, I'm thunderstruck. So many things are new. I was just on the phone with Russell Napier, who wrote a book long ignored, but now so timely. Anyway, Russell is a student of the dynamics of bear markets. He studied the one 1920, 21, 1932, 1949, and I guess a couple of others in 1982. And he reflected that the very speed of this, the violence of it, is something new under the sun. The scale of government response is something new. So these things are unprecedented, and so one must be very careful about drawing lessons from the past, and Russell is indeed careful about doing that. But for me, the lesson I've learned is that, I guess reinforced, is that, well, I'm going to quote a screenwriter from Hollywood. You're in California, right? So you know all the screenwriters. So William Goldman, who I think wrote among Butch Cassidy and the Sundance Kid, but apropos of the predictability of box office receipts, William Goldman from his lips fell one of the great quotations pertaining to all attempts at forecasting and prognostication. Quote, said Mr. Goldman, "Nobody knows anything." A period, close quote. We can know tendencies, we can observe patterns of behavior, we can project, but so what the events of the past, the violent events of the past 2 weeks have reinforced in me is the necessary humility to stay relatively diversified, relatively liquid, and to choke down any thought that begins to resemble certitude. We can't be immobilized by our ignorance of the future, but we can understand how complex the future is and how predictably it can surprise you, and will.
My guest has been Jim Grant, editor of Grant's Interest Rate Observer. You can find him at grantspub.com, on Twitter @grantspub, and I highly recommend you check out his Current Yield podcast. Jim, it's been a real pleasure. Thanks for taking time. I really appreciate it.
Oh, Albert, it's been a delight. Thank you so much.
Well, I need to say I'm fascinated by the cryptos. I'm a consumer of currencies. I'm a businessman and a businessman that does business internationally. I travel. And the idea that there are numerous currencies that would compete to offer me utility is something that I find attractive.
Rick, your mention of international travel reminds me of suitcases, which reminds me of our sponsor, Away Travel. Well, fortunately, there is no shortage of competition in luggage, and Away Travel is an avatar of the dynamism of the luggage business. Now, Away creates the thoughtful products designed to change how you see the world. The perfect suitcase was job number one, crafted with features that make travel more seamless. And now they offer a range of essentials that solve real travel problems. So all you have to do is think about is where you're headed next and who you're traveling with, and why won't that person stop talking to you? Or, if younger, why that person insists on crying in inopportune places. Because getting away, capital A, means getting more out of every trip to come.